In this video, I have four stocks for us to look at today. One is Caterpillar, the other is Home Depot, we have IBM, and we have 3M. Now, at the end of this video, I'm going to do a little technical analysis lesson, so hang around for that, and I'll teach you a little bit about how we predict where markets are going to go next. And so the first thing I want to do is just talk about Caterpillar. As you can see, Caterpillar went through a nice little accumulation stage. This is actually a reaccumulation stage, and you'll notice that it's reaccumulation because it's going sideways and it's green. There's no red in there. If we come back to the previous one, you can see as we come down, this is an accumulation stage because it's red. So it's kind of makes it easy, right? We're accumulating in the red zones. And then when we have a narrow sideways channel like this and it's all green like this, that's generally considered a reaccumulation. Now, reaccumulation, of course, means it's going to break out the top. Now, that doesn't always happen. Sometimes this becomes distribution, and even though it's green, it drops out the bottom. So we have to be careful with that and not always rely on that 100%, but that's kind of the idea of what we're seeing here. So as the market broke out the top, you can see it was a weak breakout. It went up, broke out that reaccumulation, didn't really go anywhere, gave us a nice little ABC pattern, but then it died. And so then it came in, gave us a head and shoulders formation, and then it gave us all these little shelves. I call them shelves, all right? If you look at this, this is kind of a key giveaway of market direction. If the market rallies, and then falls out the bottom of that little shelf, we're in a downtrend. If it goes down, and breaks out the top, we're in an uptrend. So that's how we kind of can see where the market's turning and making, turns in the market, whether it's bullish or bearish. But it makes these little shelves, and see all these little shelves in here. Here's another one, and then here's another one right here, and then this one gets a bigger one in here, so we get our spider web in there. This is what I call that. So we have our natural trend line, we have our mathematical trend line where it breaks the blue lights, and then we have our horizontal trend line. So that's another one right there. And then it comes down and it just starts going sideways. No trend whatsoever. And then this is where we get the Wyckoff spring down in here. This looks like to me a Wyckoff spring as this market's going sideways. And this is an accumulation stage because it's red. So that's why I feel like this market might rally out the top. So we're going to look for this market to continue higher. Now, the market's not been real strong. I mean, if you look back at the past, there's a lot of sideways trending in here. But nonetheless, this is a relatively bullish state, and we'll probably get something that looks a little bit like this. We'll probably get a little rally that comes out the top. Is it going to be a huge rally where we might want to jump in with options? No, I don't think so. I think it's just an accumulation stage where we could see Caterpillar continue higher. Now, of course, we also have the possibility that this thing could come out the bottom. That's because it's red, right? So it could come out the bottom and we could have another one down in here, and we would end up with another accumulation stage down in here. So I don't want to get real crazy and start adding on a whole bunch of stocks in here, adding a bunch of positions in here, accumulating large shares in this region, because there is the chance that it could come down. If it starts to rally, we'll always have the opportunity to jump in on these little shelves going the other direction, right? These little pullbacks, these little shelves indicating that the market is changing direction from bullish to bearish. And so remember, there's always one up for every down. It's not always perfect, but we can consider one up for every down, and we get these little A, B, C patterns as the market moves through price and time. So let's go to Home Depot, and this one we're getting basically the same pattern as we were getting on Caterpillar, right? Let's just zoom this in a little bit, and we can see back in here we had some nice little accumulation stage that went on here as the market broke and went up through that nice little Elliott wave pattern. It went sideways across here. This is the distribution stage up in here. And then it broke out the bottom, came back down into an accumulation stage. It looks like it wants to rally once again. So there's the possibility that this market could continue to rally, and so that's why it's on our list with Home Depot. We are coming into summertime. Lots of people like to do home improvements in the summertime, and people are going to be buying their Home Depot products. So we come into IBM. This is basically the same concept. Once again, we're coming down off of this nice little high. You can see all these little shelves, like I call them, little trend line shelves right in here. We got a nice little accumulation location in here, and this is where it dropped out for the second time. Now, you'll notice when we see that first accumulation, I'm always telling you, we're going through an accumulation. It could break out the top, but always be mindful that we could get a second one coming out the bottom. And this is an exact example of where that happened. It came out the bottom and gave us another accumulation stage down in here. And now I'm looking for this thing to continue to rally. So now we're going to come down to 3M. And again, I just want to point out the little shelves. I want you to be very aware of these and mindful. This is kind of a real giveaway as to market direction as we get these little shelves as the market's coming down. As long as we're making lower highs and we get these shelves, we're going to anticipate a continuation of the downtrend. You can see this came into a nice little 3-drive pattern here, little Elliott wave pattern, X 1, 2, 3, 4, And you can see that, of course, with the blue lights. The blue lights are what breaks at the right spots and gives us these little patterns, tells us where these A, B, C patterns. So that's our Elliott wave pattern on the way down, and we're going through the accumulation stage down here at what we call the X3 right here, X3A1. So there we go with 3M. Now, for a little lesson, I want to take you through and I want to show you a little lesson on how we predict where markets are going to go in the future, and I'm going to use IBM for that because it's set up nicely for this this purpose. So what I'm going to do is show you where I think IBM is going to go, and we'll save this just to see how accurate we are, but it's based on Fibonacci and areas of support and resistance. Just a very simple little Fibonacci projection tool that we can use to help us kind of identify based on higher highs and lower highs where we think markets are going to go. So notice that we've got, again, a trend line. We'll expect another trend line, and then another trend line, right? So for every up, there's a down. Every up, there's a down. So now what we're going to do is we're going to take that to the next level. I'm going to delete all these, and we're going to come in, and I'm going to use the Fibonacci tool. This is the 1, 2, 3 tool, and I'm going to go from the same low, just like we did with the trend line, from the low to the high, back down to the low. Now that gives us a Fibonacci projection. Now if this thing adjusts and comes down one more, we'll adjust it as the market moves through price and time. We're going to get that on the lowest point of the reversal, but if that's right there, then this is where we want that to be. So now we're going to go through and we're going to project up. Now markets have a tendency to go the same distance, right? This is called reflective trading. That's a concept taught by Wells Wilder. And so as this market rallies up, that same distance is going to be what we're going to look for over here, all right? So from A to B would be the same distance from C to D. And so that's why we have this scale over here. And you'll notice that it's based on volatility as well. So how long did it take to go from A to B? Well, it took this long, right? If we go back here, if it went really fast, it would adjust our projection out into the future. So we can come along here, and we have 1, 2, 3 of these. Let's just go with the furthest one out to give us kind of a little bit of breathing room in there. But nonetheless, this is your A, B, C, D pattern. That's how we project out into the future where we think the market's going to go. Now I want to show you one more little trick, because we also know that 130.9, this is a Fibonacci projection ratio, right? That's the golden ratio to the upside. We oftentimes talk about the pullback being 61.8, and in this case, market's pulled back so far to 66.7. That's right there in that Fibonacci sweet spot between 38.2 and 61.8 on the rebound. If we come in here with our little Fibonacci ruler, we can see that that's right where we're at. We're sitting right dead center of the Fibonacci sweet spot. But we can see that also on this projection tool. So it's calculated here for us at 66.7. So now we got this little projection, okay? So we got the A, B, C, D. Now where do we think the market's going to go after that? Well, we have 100% and we have 130.9. So we can actually take the Fibonacci projection tool and we can project out one more leg. So let's go off the B point from B to C, and if the market makes a perfect reflection up to 100, that's where we would expect it to go. Now if it goes up to 130.9, to the golden ratio, that would be nice, right? But we're not going to really anticipate that, but it would be nice, and we could make that adjustment if it does. So let's just go to 100 and say it's going to make the same move from B to, actually in this case, we've got our ABCs on top of each other, but we're going to come in here and we're going to make this and anticipate from C to D the same as in this case from B to C. All right, so that little drive right there is just going to be a reflection of this previous drive right here. And so now, if that's the case, the next reflection would be the reflection of this drive coming down off the top. One down for every up, so there we go. So there's our drive, and we would anticipate the next drive being the same, coming down this direction. So now, if we look at this, what we're going to see is that we see that this becomes a Fibonacci bow tie. All right, now you've all heard me talk about Fibonacci bow ties. Here's the bow tie. The concept of a bow tie is that the market rallies, it goes up, it comes back down, it makes the next rally, and then when it comes down, we're going to take this one up to 130.9, and when it comes back down, we're going to expect it to go back down to the level of the previous high to this point here. So this is the Fibonacci bow tie, and that would be our target price for the downside. All right. Now, if it only went to 100, that wouldn't be very far, right? Because this was a nice big rally and a shallow rally here. So it would go up, and this would be the bow tie. So the bow tie would actually go from this point here, down, up, back, and across. So let's redraw it like that instead of the Elliott wave pattern. So we're going to come in and just go with the bow tie pattern, which is from here. The mark goes down, goes up, and in this case, if it goes to 100 or 130.9, we would expect it to come back down to this area of resistance right across here, or support at this point. It'd be resistance on the downside, support on the upside. So that would be our Fibonacci bow tie. And so that gives us kind of an idea of where we would expect this market to be in price and time. So that's how I make my projections and my predictions on where I think markets are going to be based on accumulation and Elliott wave and Fibonacci. So all three of those are very important to work together, one in combination with the other. We use Elliott wave, we use Wyckoff accumulation, and we use Fibonacci. And of course, if you would like my book that teaches you all of these strategies and concepts, Fibonacci, Elliott wave, and the Wyckoff theory, then you can pick it up on Amazon. Just go over there and search. And the title is The Fibonacci Effect, Wall Street's Playbook of Strategies.